Afternoon. My name is Jeff Joseph. I am the president of SIIA. Happy to be the host of today's webinar. First and foremost, I hope that you and your families and your colleagues are safe and healthy and are weathering this pandemic as best as can be done. Second, I want to thank our colleagues from Nelson Mullins who joined us today for this webinar. We greatly appreciate their participation in what I'm sure will be a insightful and helpful webinar. This webinar is just one part of SIIA's broader effort to assist our members during this pandemic. We've had a series of webinars on various subjects. We launched an action center you can find on our website that provides links to various government resources and some other helpful information. Also, you'll find updates on our events and the status of our events. You'll find the work that we've done to advocate for relief for events producers and for EdTech solution providers. In fact, we have been advocating before the government to make sure that those companies are included in assistance programs. We've sent a couple of letters to the administration and to congressional leaders, and if you want to see the copies of those letters, please contact Carl Schonander. But we're also working beyond sort of the information. We're also working to provide actionable items and information for all of our members. On our action page, you can see a summary of the CARES Act that was recently passed by Congress. We've provided links to those financial assistance programs and additional federal resources. That page is promo.siia.net/coronavirus. Again, promo, P-R-O-M-O, .siia.net/coronavirus. You can also find it by going to our homepage. And some of you may have seen our recently launched newsletter, which also provides links to the financial resources and other government resources. We'll be pushing that out on a regular basis, provide updates, not just on the coronavirus, but other relevant action that's policy activities happening in Washington, D.C., across the states and globally as well. This webinar is one part of our efforts to help you understand how to access that assistance and answer your questions. And it's really important for you to give us feedback as you access these programs and apply for aid. Let us know the issues you run into so we can report back to the government so they can address those issues and try to make sure that the process is easy and understand some of the stresses and challenges that you may be experiencing. Whatever feedback we provide will be anonymized, so again, feel free to provide that information to Carl. As we move forward after this webinar, I think the next question is, well, what happens after this immediate crisis? And we want to work with our members to identify the policies that will be needed for your company to stay in business and to return to sustainability. So look for more information from us as we plan out those next steps to help you get on the back end of this pandemic. So with that, please allow me to introduce Carl Schonander. Carl runs our global government affairs and public policy work with his team, and he'll be moderating today's discussion. Carl?
Hi, so I'm Carl Schonander, and thanks, Jeff, and thank you to Nelson Mullins, and of course, reiterate, I hope everybody is healthy and stays healthy. The one takeaway, besides what you learned from this webinar, is this is, I hope, an ongoing process with you all and all other SIIA members. Very interested in feedback on just anecdotes, practical issues, challenges associated with accessing relief. We can use that, anonymize that, and use that with the government to try to improve things. So I'm Carl Schonander at cSchonander@siia.net. And with that, I'd like to hand over to Chris Moore, our General Counsel and Intellectual Property Counsel. Chris, you're on mute.
Thank you, Carl. My role here is only to get out of the way. I will be handling the Q&A at the end. And so we have three extraordinarily qualified people to take you through the nuts and bolts of this particular program. Each of them are involved in the securities practice at Nelson Mullins. I will let them introduce themselves briefly. And what they have done is compiled essentially the practicalities of accessing the CARES Act programs. And I am quite sure that you don't want to hear much from me. So with that, I will turn it over to our friends and let them take you through their presentation.
Well, thank you very much. This is David Mannheim. Certainly appreciate the opportunity. As far as who we are, we're an 800-person national law firm, and really that has a very core focus on securities work and corporate work and M&A. So that's where we all live, the three of us. The main difference between us is they have hair. Now, Mike, do you want to give your background real quick?
Absolutely. I'm Mike Bradshaw. I'm an associate in our DC office, and I work in the securities and corporate practice group. Been with Nelson Mullins for almost 7 years now.
Peter?
Good afternoon. My name's Peter Strand. I'm a partner in our Washington, D.C. office. I do mostly corporate securities. We also specialize in specialty finance. So when we woke up and the CARES Act was being discussed, we realized although our clients wouldn't be able to benefit, their portfolio companies would. And so we began working and educating ourselves on this. So we've been neck deep for the last couple of weeks and eager to help you all out.
Great. And I'm David Mannheim again, partner in the Raleigh office. And let's go ahead and move to the agenda, Mike. So we're going to first give you a summary of the different programs. Then we're going to examine the two main programs in detail, and then we'll have a Q&A. Next slide. Next. So we have three sort of pillars here. We have the Paycheck Protection Program, which I assume everybody is pretty familiar with to some degree. One of the important things is that the loans are forgivable under the PPP. The emergency economic injury disaster loans do have to be paid back. The good news is you can get some immediate relief under that within 3 days of applying. And then there's a large impact on existing SBA loans in terms of being able to the SBAs can actually pay it for 6 months, and there's deferments. So it can be powerful if you already have SBA loans. Mike?
So as I'm sure you all are aware at this point, the CARES Act had two kind of main parts in it. It was the relief for small businesses, and then Title IV, which provides Treasury the ability to make direct loans to certain distressed industries such as airlines, national security industries, and mid-sized businesses in general that aren't able to benefit from the small business lending program. The one we're focused on are the lending programs in Title I. The cornerstone program was the Paycheck Protection Program, which provides $350 billion in loans to small businesses mostly in order to cover payroll, predominantly to cover payroll. It's clear that the government was eager to get money in the hands of people and out to the economy as quickly as possible, but also to stem the rise in unemployment. And the way they did that was to piggyback on existing SBA programs. The Paycheck Protection Program is under Section 7A of the Small Businesses Act, and you only need to know that in order to contrast that with the 7B2 program, which is the emergency EIDL, Economic Injury Disaster Loans program we'll talk about later. The Paycheck Protection Program is generally available to companies with 500 or fewer employees. We'll talk about how that number can be higher. It is very important to consider affiliation rules. We'll go into that in more in depth, but when you're under common control with other businesses, you have to count their employees as well. And so that really comes into play, in particular, when you have private equity investment, venture capital investment, or corporate conglomerates, or just a business owner that owns other enterprises. The loan amount is equal to approximately 10 weeks of payroll. It's 2.5 times average monthly payroll, which comes up to approximately 10 weeks. We use 10 weeks to contrast it to the loan forgiveness amount, which is a slightly different calculation, is based on 8 weeks. And we'll go into that in depth as this presentation goes on. And it's capped at $10 million per borrower. Loan forgiveness is available, and we'll get into that later in the presentation. And the loan forgiveness amount is subject to reduction based on your reduction in the workforce. And on a high level, the Paycheck Protection Program is intended to be a grant as long as you qualify and are eligible for full forgiveness. So if you are eligible, it is definitely something that you'll want to look into. And we'll go over all that in more detail. Mike, next slide, please. The major considerations are you eligible? And if you are, how much can you borrow? How much is subject to forgiveness? And a corollary to that is how much will the forgiveness amount be reduced based on changes in payroll and wages and salary? And then we'll talk about some practical guidance on how you apply considerations and how you maximize the benefit of this program. First of all, who is eligible? And obviously the number one consideration, if you are or may be eligible, it definitely is worth looking into the program. The number one first thing you look at is, are you a business located in the U.S. that operates primarily in the U.S. or makes a significant contribution to the U.S. economy? And were you in operation on February 5th? You can have foreign ownership, you can have foreign employees, but you do have to be located in the U.S. or have kind of significant nexus to the United States. And then the other consideration is, are you below the size thresholds for eligibility? The CARES Act created a new size threshold, although you can use traditional SBA size thresholds. It's the new one is 500 or fewer employees, or such larger amount if provided in the SBA size standards. So the SBA has a table. It's based on industry, so you have to find your industry code and then see what the size standard is. If it's an employee standard, for example, manufacturing is often much higher than 500, then you can use that higher employee number for the purposes of this test. You must include affiliates, as I said earlier, unless you're in the hotel and restaurant industry, you're franchise listed on the SBA franchise directory, or you're a company that receives financial assistance from the SBIC. For hotels and restaurants, it's 500 or fewer employees per physical location. So that's a big help to hotels and restaurants. You also must certify that quote, current economic uncertainty makes this loan request necessary to support the ongoing operations of your company, end quote. And if you're lucky enough to not have been negatively affected by the coronavirus or the subsequent shutdown or the economic uncertainty or the drop in the market, then this program really isn't for you. You probably shouldn't be pushing the envelope, because as we've seen in 2008 and previous recessions with massive government programs, on the backside there's often a look back, and they'll look back and they'll make sure that everyone used the program correctly and there wasn't and no one took advantage of the program. So if you're not being disadvantaged, if you're not economically harmed through this whole process, it's probably best to sit this one out, just from an optics perspective. But that you may still be able to make the certification, even if you're not even if you had a good first quarter, but you expect in the future that you may have trouble. Certainly, if but for this loan, you would have to reduce your workforce. Then you can make the certification. I mean, that's what this is for, is to keep people on the payroll, to keep them employed, to keep money in their pockets, and keep you operating at pre-COVID levels.
All right. There are also several pre-existing SBA eligibility requirements. Certain industries and types of businesses and persons are not eligible to receive SBA funding. They weren't pre-CARES Act, and they are not now. The CARES Act modified this a little bit. Here's just sort of a laundry list of some of the ineligible persons and businesses. Some highlights would be household employers, if you're employing a nanny, something like that. Financial businesses that lend, such as banks. Passive businesses owned by developers. A lot of real estate investment firms, fall into this. You have, life insurance companies, businesses that have previously received SBA funds, defaulted on it, and caused a loss to the government. If that's happened within the past 7 years, they are not eligible for a new loan. Any business that's engaged in illegal activity is precluded. And likewise, a business who has an owner that's incarcerated, has certain criminal background, or was convicted of a felony in the past 5 years. And then if you are already a business that's in bankruptcy, you are also not eligible. Now, Peter will talk about the affiliate.
Sorry, I was talking into mute. I just want to say, back on the eligible employees, you do not include independent contractors. Independent contractors are able to get the PPP themselves. And so the SBA has said that that you cannot count independent contractors, and that they will have to apply themselves. Onto affiliate issues. As we said, if you're under a common control with other companies, then you have to include their employee number when you're trying to calculate how many employees, whether you fall under the size threshold. Control is a very loose concept under the SBA guidelines. It's a quote, totality of the circumstances test, which means they will look at ownership, they'll look at management, they'll look at other control factors like negative control, like veto powers, and they'll take them together. So there's not a bright line rule. You just have to look at the totality of the circumstances. The SBA has issued some guidance in an attempt to relax the standard, but in practice, it really hasn't offered much clarity at all. Ownership of over 50% in a company, that's control. If there's no one that owns over 50%, you look at common management. And if there's a minority holder, 20% or more, that also has certain negative control factors, this is very common for private equity or venture capital. They may have less than 50%, but they have veto powers. Veto powers have to be, in order to find control, it's veto over day-to-day business matters, not extraordinary business matters. There's a long list of things that the SBA has said are ordinary and things that are extraordinary. Ordinary would be budget, influence over management's day-to-day decisions, ability to determine management's compensation, ability to remove management, and these are veto. So if that party has that sole ability to do these things, then they will be deemed to be controlled. If you have veto powers over mergers or declaring bankruptcy or selling substantially all of your assets. Those are extraordinary, very common in operating agreements, but those will not in of themselves be trigger the control. So this is a case-by-case analysis. I wish I could give you more details. A lot of the questions we're getting in regards to the PPP are based on this affiliate concept. And if you're kind of on the cusp, it's worth asking for additional advice.
The next sort of big question is, if you are eligible, how much can you borrow? The formula that's set forth is there's a $10 million cap, as Peter mentioned before, and then you look at 2.5 times your average total monthly payments of payroll costs during a 1-year period prior to the date the loan is made. You can either use a rolling 12 months, or you can look at calendar year 2019 when you're calculating that average monthly payment. If you're a seasonal business, there's a slightly modified period. You can use basically the spring of 2019 and look at your average payroll costs during that period. In addition to that, you can also borrow the amount of any 7B2 disaster loans. That's the emergency economic injury disaster loan that we mentioned as one of the other pillars of the CARES Act. If you've received one of those between January 31st of this year and April 3rd of this year, which was the first day that you could apply for a PPP loan, you can borrow an amount of money under the PPP program to refinance that EIDL loan. You're still subject to the $10 million maximum. And if the EIDL loan was used towards payroll costs because you got it back in January, you needed to use it for that, you have to refinance that using the PPP program.
So payroll costs is something that's defined in the CARES Act. I just want to point out a couple of things about it. It's used both to calculate the loan amount that you can borrow and also the forgiveness amount. So it's an important concept. Payroll costs include salary, wage, commissions, or other compensations of employees. I will note that it's gross salaries. So you do, for the purposes of calculating payroll costs, you include amounts withheld under federal income tax withholding rules. So it's gross. It also includes payment of cash and tips, payment of vacation, parental, family, medical, sick leave, allowances for dismissal or separation, payments to group health benefits, payments of retirement benefits, and this likely includes matching 401k, employer matching of 401ks. That's how I've seen a lot of people reading it, and there hasn't been any guidance to not support that. And then also payment of state and local taxes assessed on the compensation of employees. I will say there are a couple of special rules. Very importantly, for people that earn more than $100,000 in salary, you count only up to $100,000 of that salary, but then you can count the other benefits costs listed above in addition, above $100,000. So that's per employee. And then you do not count any compensation of employees who have a principal place of residence outside the US. So this is only available for US residented employees. And you exclude any qualified sick or FMLA leave wages that you're getting credit for under the Family First Coronavirus Response Act. So you can't do both.
All right. One of the big draws of this program, of course, is the loan forgiveness on the backside of it. The loan can be forgiven for up to the entire principal amount. There are provisions that reduce that forgiveness if you reduce your workforce or cut salaries or wages. There's also guidance from the SBA and Treasury that says that you have to use 75% of the loan funds you receive towards payroll costs. That wasn't in the CARES Act, but that's a requirement that will be enforced. The loan forgiveness amount is calculated as actual amounts that you incurred or paid during the first 8 weeks of the loan. for permitted uses, and those are payroll costs, interest on mortgage obligations, not the principal or any prepayment, rent costs, and utilities. And there's also a reduction that's proportionate to any reduction in your workforce and any decrease in salaries or wages of employees that earn less than $100,000. You just, again, keep in mind that the purpose of this is to keep people on payroll, keep paying them what you were sort of pre-coronavirus. So if you can maintain that through, 8 weeks after the loan, that will be forgiven. Here's some more detail on the forgiveness formula. To calculate the reduction in workforce, you take as you have the numerator is the average number of full-time equivalent employees that were employed during the covered period, and you divide that by the average number of full-time employees that were employed February 15th to June 30th of last year, or that same average from January 1st to the end of February this year. Then full-time equivalent employee, that definition is a little unclear. We won't go into the details of that, but keep that in mind. That's more of a kind of labor and employment question. To calculate the reduction in salaries and wages, you look at the amount that the total salary or wages for any employee has decreased more than 25%. If they've got more than a 25% pay cut during this period that's being looked at, as compared to the most recent full quarter that they were employed prior to this period. And you don't look at any reduction of pay to employees that received more than $100,000 annualized pay last year. There is a cure provision, however.
Yeah, so if you have reduced your workforce or the wages or salaries paid to any employee between February 15th, 2020 and April 26, 2020, you do not need to count that reduction against your loan forgiveness amount if by June 30, 2020, you have reversed any of those reductions in their entirety. So any reduction in workforce has been remedied, and any reduction in wages or salaries has been reversed. And that's an all or none cure. And I will note, wait until June 29th to bring everyone back on payroll. That's perfectly acceptable, but the calculation of payroll costs for the purposes of seeing how much of the loan can be forgiven will naturally be smaller. So that's kind of the rub there. This cure is an all or none. I think that's very helpful when we're talking about the loan amount, figuring the loan amount and the forgiveness amount, to use a numeric example. We've picked these numbers because they're nice round numbers, but say in 2019 you had $6 million payroll. That's $500,000 per month, and that means 2.5 of that is 1.25 million. So you'd be able to borrow up to 1.25 million under this program. Assume your payroll stays the same. That would be 2 months worth of payroll, or $1 million of forgiveness. And then you'd have $250,000 left over. Presumably you'd be able to cover that based on additional amounts you paid in rent, mortgage interest, or utilities. And up to the full amount of the loan, it would be entirely forgiven. Now, the forgiveness amount would be subject to reduction. So if you reduced your workforce by a third, you'd have to reduce the amount of the forgiveness by a third. And then anything left over would be rolled forward into a 2-year loan at 1%.
So we covered permitted uses a little bit before, but we just want to highlight that it really is geared towards payroll, healthcare benefits, salaries, commissions. You'd notice that it included tips as well. Rent obligations, utilities, interest on debt. You cannot get credit for the actual debt pay down, and then refinancing of the disaster loans. Next. So when they originally came out, they were supposed to have an interest rate of 0.5%. They have subsequently raised that to 1%. It's a 2-year term, no prepayment penalty. There's no administration fees. You don't have to demonstrate that you're not financeable or bankable. There's no collateral or personal guarantee required, which is very unusual for an SBA program. You have deferment available for 6 months, and the loans are non-recourse as long as used for permitted purposes. And here's the biggest one. Debt forgiveness does not count as income for tax purposes. Because normally you would have to recognize the amount of that forgiveness as income. So that's a pretty powerful provision right there. Next. So as far as practically how do you get it, lenders are taking applications now, and we recommend applying with your current lender if possible, because there's a lot of the lenders who will not process these loans for people that are not pre-existing clients. And then there are, if you don't have a relationship with one, there are some that you can find who will take you on, but the big banks are generally not taking on anybody who isn't a client.
Yeah, I do want to cover a couple of kind of high-level things. Wells Fargo has stopped processing applications. As of last night, that's no longer true. They got the regulatory relief. I believe, I don't know if in practice they're accepting applications yet, but they've said that they will immediately begin accepting applications again. So that's just all a great segue into saying all of this is still somewhat in flux. We've received FAQs, guidance, form documents. There's an interim rule. There's lender implementations that vary from lender to lender. So everything's in flux. To a large extent, a lot of this will be determined by how your lender interprets the program. So you may think that the calculation goes one way, your CPA may think the calculation is another, and then the question is, can you get a loan officer to approve the loan? There was a big rush to get the loans in and not have them be kicked back because you wanted to get in queue and you didn't want the funds to run out. Now, it seems like pretty much everyone in Washington is in favor of re-upping this program if it runs out of funds. So maybe the urgency is a little decreased there, but there is still a sense of urgency, not to mention the fact that you don't want to cover payroll in the meantime as you wait for this loan. Even if you aren't eligible, it's important to think about the people in your life that are vendors, maybe some of your members or suppliers, customers, even family members. This really is, the government is trying to get money out, and this is not one of those instances where pride has any value. We would recommend taking advantage of this program if you can.
Great. So the other type of loan that we wanted to discuss are these emergency economic injury disaster loans. This is another pre-existing SBA program that's sort of been modified to apply to coronavirus. The CARES Act set aside an additional $10 billion for loans under this program. It's generally used for, there's some sort of disaster like a hurricane. The governor of a state will declare that state a disaster area. And if you are a business and your business is still standing, you don't have an insurance claim on the building, but nobody is on the boardwalk anymore, you're not getting any foot traffic, you can get this loan to help you with the economic injury that you've suffered. So coronavirus, most if not all state governors have certified that their state is a disaster area. So these have been expanded to cover losses due to coronavirus. These are 30-year loans for an amount up to $2 million, and the interest rates have to be less than 4%. The CARES Act also expanded the eligibility of the types of businesses that can apply to these. In addition to small business concerns, you can also certain nonprofit organizations can apply, small agricultural cooperatives, and then businesses with fewer than, or not more than 500 employees, and sole proprietors or independent contractors. Similar to the PPP program, there's sort of a threshold question: have you suffered or are you likely to suffer substantial economic injury as a result of COVID-19? One interesting feature of these loans that we touched on briefly earlier is that there is a $10,000 advance that is available. That program basically allows you to apply for an EIDL, for up to the full amount, but you can receive $10,000 of that loan amount within 3 days of submitting your application. Basically, no questions asked. You have to use that for an allowable purpose, such as payroll, paid sick leave, things like that. And you have to certify that you are eligible to receive the EIDL loan that you've applied for. But this $10,000 advance does not need to be paid back, even if you are subsequently denied the loan. So that's a great immediate help for some businesses. These loans are automatically deferred through the end of the year, and the application requirements for EIDLs under the existing program have been relaxed for these coronavirus applications. You don't have to have been in business for 1 year. You just have to have been in business as of the end of January. There are no personal guarantees required unless the loan is more than $200,000. Normally, you would have to submit tax returns and other documentation for underwriting. Here, the loan can be granted based on credit score alone. And then finally, for loans that are less than $500,000, the SBA will just rely on the certification that the applicant is a small business concern. The thought here is that we want to get this money out quickly. We don't want to have to spend too much time checking every box and pouring through all these documents for every small business.
Yeah, so I've received some anecdotes about the EIDL program. Seems to be kind of all over the place. The SBA there's been some delay in processing these loans. These loans are made directly by the SBA as opposed to the PPP, which was through a bank or lender. And the $10,000 advance, at least for a while, I don't know if the SBA is still doing this because there was a huge amount of backlash, but it was limited to $1,000 per employee. So if you had less than 10 employees, you couldn't get the full $10,000. And then it was taking longer than 3 days to hit people's bank accounts. So, in practice, the SBA is incredibly overwhelmed. Traditionally, they've been a very slow-moving entity. It's slow and deliberate. I don't mean that to be completely negative, but slow and deliberate. And now they've been tasked with these 2 huge lending programs. So, there have been significant growing pains, and EIDLs have, in a lot of ways, have been taken a back seat to the PPP, but EIDLs still serve an important role, especially for people that maybe don't have payroll or are going to need to lay off a lot of people, and therefore the PPP is not ideal. They may still look at the EIDL and be able to get an EIDL that they can spend on things other than payroll and the other PPP permitted purposes.
So the other, go ahead.
As Peter mentioned, you apply for this loan directly at the SBA on their website. It's relatively straightforward. I think we mentioned earlier that you can refinance your EIDL into your PPP loan. And if you've used your EIDL to cover payroll, you have to refinance it into the loan. But this will, you want to check with your lender on all of this. And then another important point is you can't double dip. You can't get a PPP loan and an EIDL loan covering the same purpose.
So then there was another pillar here, which is the SBA relief for existing loans. These are existing, SBA loans. The SBA will pay the principal, interest, and fees on these loans for 6 months, beginning with the next payment date. Loans already on deferment will receive 6 months of payment after the deferral period, and the SBA will encourage lenders to provide deferments and will allow lenders for up to 1 year to extend the maturity of SBA loans and deferment beyond current limits. Those are all pretty powerful pieces of the program that did not exist before this.
I'm actually going to just jump in and answer some of the questions that have popped up that I can answer quickly. There's one here. It says, I acquired the assets of a company I owned in December. Can I use the tax and payroll from the previous company? Yeah, I mean, as long as the company is a natural successor. In other words, enterprise hasn't greatly changed in the meantime. Yes, you can use those figures. It's as the successor entity can still use the PPP. Full-time contracts or consultants, you do not include independent contractors, as I said earlier, 1099s. So because they can get the PPP themselves. So unfortunately, the SBA has said that it's up to the independent contractor to apply for the PPP. For those for those consultants or people that are so like employees that they're common law employees, it's unclear. In traditional SBA analysis, you could include a common law employee even if they were carried on someone else's payroll, such as a professional employment organization or similar payroll company. There is guidance that says that you can include those people as employees, but I will say the real challenge is going to be getting the lender to agree to your calculation. And that's just one of those things where the CARES Act, it's going to be very difficult to get these overworked loan officers and banks to agree to your analysis when you're putting a round peg in a square hole, unfortunately. So yeah, it should be permitted for those consultants that are so much like employees, but it still might be difficult. Sorry, I'm just reading some of the questions we've received. I have an employee who worked in January, now unable to work, so they will not be on the payroll. Can I hire a replacement that will satisfy the requirement? Well, so they're not within the cure period, so you can't rely solely on the cure provision for this person. They won't affect that analysis. But the calculation is for when you're looking at reduction in forgiveness amount for any reduction in payroll, sorry, not payroll, but workforce, is simply full-time equivalent employees over the period of the loan divided by the number of full-time employees over the comparable period, whatever period you end up using. So it doesn't distinguish between who the full-time equivalent employee is, just that the number is high. So yes, you could hire someone else and they would satisfy that calculation.
So another question was, if you applied for the EIDL more than 3 days ago and have not heard back, does that mean you were denied? No, it just means that the government's behind. Affiliation rules, do they apply to the EIDLs as well? And yes, they do.
I also want to say, while we have the mic open, we can make these slides available to you all if you want to look over them some more, or if you have additional questions.
Mike, you want to handle a couple of these?
Sure. Question about medical insurance. If the employer pays 75% of the premium for employees, Is that the amount they would add to the payroll calculation? I believe it does. I think
Yeah.
so, Peter, right?
Correct. And just want to make it clear, because this question comes up occasionally, it's just group health. So, dental, vision, health, the usual. It is not long-term disability, short-term disability, key life. Those would not be included, just the group health amounts.
There's another question. Can an independent contractor apply for a PPP on their own? The answer to that is yes. When the business is calculating the number of employees it has to exclude independent contractors for that reason, because independent contractors can apply for this on their own. So this goes back to what Peter mentioned earlier about, don't just think about your business, but think about people that are related to your business and other people in your lives. If you're a business that has a lot of independent contractors, make sure that they are aware of this program.
And that independent contractor can get up to $100,000 of the compensation they got as an independent contractor over the 2019, over the period. Yeah, so this is kind of the other million-dollar question we're seeing a lot, which is the concept of economic hardship. I would say the EIDL does require a showing of economic harm. That is a loan that's supposed to make you, it's a make whole loan. So it's supposed to make you whole as if the disaster had not happened. So there is a showing of economic harm required there. At the very least, your revenues went down or so on. So you can show that you've been harmed. The PPP, the certification is a little different. It's that the uncertain economic times make the loan necessary to continue operations. Now, very difficult kind of to parse that. Kind of depends on your viewpoint, how conservative you are, how worried you are about the optics. But really, even if you haven't been affected yet, is there a possibility that COVID, an extended shutdown, an extended recession, a rash of bankruptcies or insolvencies in certain industries, could that affect you, or is it probably going to affect you? I wouldn't try to get too cute with this, because like I said, on the backside, there's often the government will look at how these loans were used, and there's a special special investigative unit that's going to be looking at fraud and misuse of these programs. So we have to be aware that there will be people looking at it. So you don't want to get too cute. However, the loans are, the government wants to make the loans. They want the money to get out to support payroll. So if you can make the representation that you are likely or it's possible or probable that you're going to see harm, certainly, like I said earlier, but for getting the loan, you would have to decrease payroll. Then that's easy. Yeah, absolutely. Get the loan. If you anticipate that your revenues are going to go down as a result of all of this, COVID, but also a possible recession or to just shut down social distancing, then you probably can make the loan. Certain industries and certain people are particularly conservative about the optics, and I'm not really answering the optics. I'm more answering legally, could you do it? But that's also a very important consideration. So there's no distinguishing factor as far as voluntary separations or firings. Certainly, if you reduce wages, more than 25%, that's, not voluntary, but there's no differential in the CARES Act as far as whether someone leaves because they quit or someone leaves because they were fired. They're all treated the same. They're all treated as a reduction.
Hi, this
And
is
the idea is that it's unlikely to have people quitting in this type of an economic environment. Everybody's going to hunker down in their job as long as they can.
Well, yeah, but even in the most extreme case, say, God forbid, someone died or became permanently disabled because of COVID, they technically would count, towards all these reductions in workforce. So technically, they would affect the calculation. The calculation doesn't take into account circumstances.
I've got a couple of questions that have popped up on the chat list that may have not shown up in the Q&A. The first one is the amount that can be included for health insurance benefits the gross amount a company pays its insurance company, or that amount minus the employee contributions to that cost?
I think it's the net amount. It's the amount that the employer pays. These are all kind of payroll costs is costs of the employer.
Okay. One note from one of our participants, it's a comment, not a question, and that they're a commercial lender, and his bank, as well as some others, have spreadsheets on websites that can help you calculate eligibility. The next question I've got is, I'm reading today that the advance only extends to 1K per employee, $1,000 per employee. Have you heard that guidance?
Yeah, so that's for the EIDL. That's the EIDL advance. I have seen that. That's how the SBA is now implementing this. There's a huge amount of backlash as a result, because that's a constraint that just hasn't existed before today or yesterday. I'm trying to remember when I started seeing reports of this, but so there's a huge amount of backlash because, as you can imagine, the EIDLs for small businesses with less than 10 people, they were really counting on the 10K. Mm-hmm. And the other thing you're seeing is it's taking longer than 3 days to get the advance. And that's another thing that was promised that's really affecting people's bottom line, the people that need it the most. There's a huge amount of backlash in regards to those two items.
And then I have a question that I'm asking for a friend. Suppose you have an organization, well, suppose you have two organizations, right? Suppose they have both of them have less than 500 employees, and one is a nonprofit, one is a 501c6, and one is not. Both of them have government relations departments with people on staff, but that is not their primary source of revenue. They gain revenue through other ways. Are they still eligible for applying for payroll protection for any of these programs? Are they excluded?
Yeah, so the payroll protection program, I'm sorry, the paycheck protection program, excuse me, it is available to 501c3s, nonprofits that are 501c3s.
But not C6s.
Right. It's not available to other 501 nonprofits. The EIDL is available to 501Cs, Ds, and Es, I believe. Now there are instances, there are disqualifying instances. You can't be primarily engaged in lobbying or pushing a policy or agenda. There are other restrictions, and I don't know if they were listed in Mike's list of ineligible companies, but you would want to make sure in the case of the 501c6 that is trying to get the EIDL that they don't run afoul of any of those ineligible businesses.
Okay. Thank you.
And and the 500 employee test still applies, and the affiliate issue still applies. However, if you're affiliated based on a common cause, such as a religious religious connection, then you do not have to count them as affiliates.
This is Carl Schonander. Quick question on the EIDL and the PPP program. So PPP is for companies with 500 employees or less. And we've talked a lot about how EIDL can be used for small companies, but can companies that have more than 500 employees apply for EIDL relief or not?
There are certain companies that can, based on the SBA standard. They have industry-specific standards for size. It's a long table where you have to look up your industry, and then they might, for this specific type of agriculture, it might be 750 employees is considered small. For this certain, oil drilling, you might have, 1,000-something employees is the threshold for small. So those standards still apply, but in general, the 500 rule is the one that will apply to most.
Yeah, in general, the standards are the same. The waiver from the affiliation rules for hotels and restaurants and people in the franchise directory for the SBA's franchise directory, and then entities that receive SBIC, which is Small Business Investment Company financial assistance. That waiver probably only applies to the PPP. So it's actually more restrictive on the EIDL from that perspective. But yeah, generally the same rules should apply for the PPP and the EIDL. There are exceptions, but small ones.
So if I may ask again, if you're, I don't know, you're a company with 100 employees and you're trying to figure out whether to apply for PPP or EIDL, what factors should you take into consideration when deciding what program to apply for? Because you said you could only be eligible for one.
Well, so you may do both as long as the use of the funds are not the same. So you cannot get an EIDL for payroll and then get the PPP. Could you get the EIDL and have it cover other, paying for wastage or paying for inventory, possibly, and then you could get the PPP and pay your payroll. So you can probably get them both. In practice, it's becoming more and more difficult. The SBA and the lenders are really pushing the PPP in particular. But if you have 100 employees, if you have payroll, the PPP is the place to start because it's forgiven, or it's probably going to be forgiven. If you have to fire everyone, and therefore the loan forgiveness is going to be small, or you have a small payroll, so the loan amount is going to be small. You may have to look at the EIDL as opposed to the PPP. But generally, if you are eligible for the PPP and you have payroll, that's where you want to start.
And it looks like there was one more question just asking about the 501c organizations again. For the PPP program, the only 501c nonprofit organizations that are eligible are 501c3s and 501c19 veterans organizations. A 501c6 is not eligible for the PPP.
Just real quick, we got a question. What are our top 3 sources of current information about the PPP and the EIDL? The Treasury website, at the top, it says, what is the Treasury doing for you? If you click there, that has the links to all the guidance, all the FAQs and the form documents. That's the #1 source kind of for academic information. But for practical information, for the PPP, you're gonna wanna go to your lender because each lender is actually implementing this a little bit different. And so you'll want to know, what documents they're using. what forms they're asking for, what documentation backup they're requesting, what their underwriting process is, and that will vary lender to lender. Do we have a second? Yeah, there's also, so the Treasury announced today that the Fed is doing a lending program. This is outside the scope of this presentation, but the lending program is called Main Street Lending Credit Facility, and then there's another program that's related. But this is, I mentioned briefly Title IV, which is the direct lending to certain economically hit industries, airlines, air cargo, national defense companies, and then there was a bucket that was just general distress lending that the Fed can do. And so the Fed created this program for mid-sized businesses, which they define as businesses with less than 10,000 employees. They announced today this program. There's a term sheet, but we really don't have that much information on it. It will be administered by banks. So you'll want to go to your lender to ask more information, but they probably don't have anything for you yet. This is a program that's going to be implemented over the next week. The comments are due the 16th, but they'll probably start kind of implementing it before then. So if you're interested in that program, maybe you're too large for the PPP or you don't qualify for some other reason, you'll want to reach out to your lender and ask if they have any information about the Main Street Lending Credit Facility.
Okay. Well, we certainly want to be respectful of your all's time. And okay. There's one more. This is the last one. Chase took our PPP application, and we're a 501c6. Have we been misled?
You know, that's, go ahead, Mike.
Yeah, I was going to say, I'm not familiar with Chase's application, but I know the SBA form application asks you what type of entity you are, and a 501c6 would not be able to respond to any of those on the SBA application. Mm-hmm. So maybe Chase has it set up differently, but yeah, everything I've seen says that 501c6 is not eligible because nonprofits are generally ineligible for this program, and for 7A loans from the SBA, and the CARES Act only expanded that to certain nonprofits, and a 501c6 is not one of those.
And they did that in the statute itself, or through regulation?
In the statute itself.
Okay. All right, so there's no hole to argue about. All right, well, with that, I guess we can't really applaud our panelists. We don't have a button for that. But bravo, thank you guys so much for doing this. I think it was extremely informative for me, and it was extremely informative for our members. As we've said, the slides will be made available. There are also checklists that our presenters have kindly made available to us. And I hope that somewhere in that material there is their contact information, which I would encourage you to use if you have questions particular to your situation about how to navigate this and how to make certain judgment calls about your business, which is SIIA cannot advise you on what to do. I can't, no one here can, but these guys can give you particularized advice. And if you are uncertain about something, they have said that sooner or later, someone is going to come back and look at this. It's not going to be now, it's not going to be tomorrow. And I can tell you, fighting the government is like fighting the ocean. They're bigger than you and they never get tired. It's not a situation that you want to be in. So if you think you need advice, then you need advice. And part of our job is to be sure that you have access to folks who can give it. And then I'm going to stop talking. I don't know if there's anything else that anybody wants to add.
Well, thank you, Chris. That's very kind, and we are happy to answer any questions.